Hi friends. Yeah, I hope the voice is clear for you. Okay. Yeah. In this video, we are going to continue with the concept again. So in the previous lecture, we have seen the adjustments from 1 to 5. Okay. That is 1, 2, 3, 4, 5. What we have discussed are outstanding expenditure, prepaid expenditure, accrued income, advance received income, and fifth one is set off. Okay. Yeah, but in this video we are going to discuss the adjustments, next adjustments, fifth one, which is depreciation. Sixth adjustment, I'm sorry. Sixth adjustment is depreciation. The adjustment entry for this would be, okay, 1 minute, let me draw my lines so that we can write the adjustment entry here. This is the place where effect in trading and P&L account, and the place is for balance sheet. Okay. Here we are going to write here adjustment entry. Adjustment entry, effect in trading and profit and loss account, and here the effect will be in balance sheet. Effect in balance sheet. Okay, let us see about now this one, the entry for depreciation. But what does it mean by depreciation? Depreciation is a non-cash expenditure of an asset. Okay, depreciation is decrease in value of an asset due to usage and wear and tear. Okay, that means that is decrease in the asset. As it is decreasing, the usual balance of the asset will be debit side. As we are decreasing the debit balance, we have to credit the asset account to asset. For except the land, the depreciation will be done. Okay, the depreciation is decrease in the value of assets, so we are going to debit the depreciation. Depreciation account debtor to asset account. This is the entry, that is adjustment entry for depreciation. I repeat, depreciation account debtor to asset account. Depreciation is a non-cash expenditure and it is wear and tear. This is decreased due to the wear and tear and usage of the assets. Okay, but except for land, that would be appreciation. But appreciation is not a big adjustment that we can easily do. That would be coming in next classes. Okay, depreciation account to asset account. Then I also said there will be two impacts. That one impact would be when it is given in adjustments. When it is given in adjustments, and the second impact would be when it is given in trial balance. Second situation, that is not impact actually, when it is given in trial balance. When it is given in adjustments and when it is given in trial balance. Let us see the first situation. When it is given in adjustments, then what we need to see? See, as it is a depreciation, I said this is a non-cash expenditure. That means it is an expenditure. As it is an expenditure, it is to be debited to. This is an expenditure in profit and loss account. I have already said maintenance charges. It is to be debited to profit and loss account. It is to be debited to profit and loss account, and it is an asset, right? And it is a decrease in the value of asset, so it is to be deducted it is to be deducted from respective asset in balance sheet. It is to be deducted from respective asset in balance sheet. Okay, when it is given in trial balance, let us look at the journal ledger for that. So let us think this is asset account, and let us take here the depreciation account. Okay, let us incorporate the entry. When it is given in trial balance, we know that the above entry was already recorded, but this is not applicable for all the situation. The above entry was already written. Okay, when it is given in trial, let us as it is an asset account, this would be having depreciation, the debit balance, that is to balance brought down. And as asset account, in asset account we are going to write on the credit side by depreciation, and the balance would be by balance carried on. Okay, that is to balance brought down here. That is, the asset account would be decreased. That means there is no need of, again there is no need of writing in the assets. That means in the balance sheet there is no impact. Let us see for depreciation, in depreciation to asset account, and carried on balance here, brought down balance would be here. That is, it is having debit balance, and if it is having debit balance, don't think that it is an asset. Okay, it is an expense. That is why it is having debit balance. So there is no impact when it is given in trial balance. When it is given in trial balance, it is only an expense and to be debited to profit and loss account simply. Okay, this is what the adjustment number 6 is. And next adjustment, the 7th adjustment, which is interest on capital. Interest on capital, very easy adjustment, simple adjustment. Interest on capital, capital is the amount of money which is brought by the brought down by the proprietor in the business, which is put by the proprietor in the business. So the interest which will be there on the capital, that would also be added to the capital, and capital is always having credit balance, so this interest is also to be added to capital, and this would be like an expenditure. So one more thing, let us write here the nature of the entry adjustment also. This is an expense. Okay, and interest on capital is also like an expense, because it is payable by the firm to the proprietor. Okay, let us write the adjustment entry, which is what? Interest on capital account debtor to capital account. Okay, this would be the adjustment entry, because it is an expenditure, that is why we have debited, and it is to be added to capital, that is why we have credited the capital account. So again same two situations when it is given in adjustments. When it is given in adjustments, then what we need to do, and when it is given in trial balance, and what we need to do. When it is given in adjustments, as it is an expenditure, we have to debit to P&L account, debited to P&L account, and added to capital in balance sheet. Okay, it is to be debited to P&L account and it is to be added to capital in balance sheet. But when it is given in a trial balance, we shall see again accounts again. So let us take this as a capital account, and let us take here the interest on capital account. Capital account would be having credit balance, that is buy balance. 1 minute, let me write it clearly. Buy balance brought down, as it is an interest which is to be added to capital, so we have to credit by interest on capital. That is also to be added, so the total balance would be written in both either side. That would be carried down here. That means interest on capital is already recorded, that is already incorporated. That means above entry was already done. Okay, so simply what we need to do, let us see here the interest on capital account also. So here to capital, and the carried on balance would be written here. So the total balance would be brought down again, as it is an again the debit balance item. This would be like an expenditure. Okay, it is to be debited to, simply debited to P&L. It is to be simply debited to P&L account, but nothing is to be done in a balance sheet, as it is already added to the capital back. That is the entry nature of this item. So next item, this is, I think, suppose this is 7th one. Let us now take 8th one. 8th one is nothing but interest on drawings. So this is the drawings. Drawings are personal expenditure of drawings are the amount is the amount which is taken by the proprietor for his personal use from the firm. So it is payable and liability from in the point of proprietor, and that would be like an asset, but that is also to be decreased from the capital. Okay, interest drawings or interest on drawings to be decreased from the capital actually. So these are going to be deducted from the capital. That means it is the overall effect will be in the capital, but we have to look at the drawings here. The interest on drawings, of course, drawings will be taken by the proprietor, and interest which is payable also by the proprietor to the firm, that is added back to the drawings. Okay, that means drawings are again to be debited. Drawings account at R, which is to be debited by to interest on drawings. To interest on drawings account. Okay, drawings account added to interest on drawings account. Okay, this is the adjustment entry. Then again, when it is given in adjustments and when it is given in trial balance, when it is given in adjustments and when it is given in trial balance. So it is in drawings is like an income to the business. Okay, that is interest on drawings is an income because it is receivable from the proprietor. It is receivable by the firm from the proprietor. So it is an income. So income is also always to be credited to capital. Interest on drawings to be credited to profit and loss account. Okay, when comes to the adjustment in the balance sheet, it is to be added to drawings and of course the drawings is to be deducted from the capital, or we can also say that it is also or deducted from capital. This is when it is given in adjustments. Okay, that means let us see the drawings account when it is given in trial balance. If we incorporate that entry, then what would have be happening? Interest drawings is a debit balance, to balance brought down again. Okay, and interest on drawings is added back to drawings to interest on drawings account. This is written here like this, and carried on balance would be total balance, and brought down balance would be here. Okay, that means this balance is together with the interest and also the open balance of drawings. So when it is given a trial balance, then there is no need of again adding back to the drawings or deducted from the capital. Simply it is to be shown as an expense. So that is not an expense, it is of income actually. And when we see here the interest on drawings account, okay, by drawings, so carried on balance would be written here and brought down balance would be written here. That means it is having credit balance, so it is simply to be shown, it is simply to be credited to P&L, and it is nothing is to be done in the balance sheet, as it is not going neatly, I know. So let me redo in a neat manner. So let us try take neatly, and we shall have in a nice manner. Okay, let us take that one. Now the adjustment entry 8th we have completed, and let us take now the 9th adjustment. 9th adjustment would be the goods withdrawn for personal use. 9th adjustment would be goods withdrawn for personal use. Goods withdrawn from personal use. As we know, this is goods. Goods are nothing but the things which we have purchased here. Okay, and these goods are to be deducted from the purchases because that are going to be withdrawn from the purchases. Okay, so it is like a drawings to proprietor. So drawings account debtor, as it is goods withdrawn, so we are going to credit with purchases. When it is given in cash withdrawn for personal use, then we are going to write the entry drawings account debtor to cash. When it is withdrawn from the bank, we are going to write the entry drawings account debtor to bank. Okay, as we are withdrawing the goods, we are going to write the entry drawings account debtor to purchases. Okay, this is what drawings account debtor to purchases account. So what would be the situation when it is given adjustments? And what would be the thing when it is given in trial balance? Most of the cases it will not be available in the trial balance, but we have to learn the things right when it would be given in trial balance. What we need to do? Actually, it will be given in the terms of drawings only. But the drawings we cannot identify whether it is a cash drawings or bank drawings or purchase. That means goods withdrawn. We are not able to decide that them. Okay, we shall see. When it is given adjustments, what we need to do, and when it is given trial balance, what we need to do. And also, this is a drawings account related to purchases. That means we are decreasing this from the purchases. So what we write is it is to be deducted. It is deducted. It is deducted from. It is deducted from purchases in trading account. It is to be deducted from purchases from trading account. So, and it is a drawings, and also we know drawings is to be deducted from the capital, right? It is to be deducted from capital in balance sheet. To be deducted from the capital in balance sheet. When it is given in trial balance, what we need to maintain? Let us maintain one drawings account, and also let us maintain purchases account. Drawings account that are two purchases, so we are going to write two purchases. In carried on balance, we are going to write the same. We are going to write the total here, and there is a brought down balance. So we are going to have a debit balance. So there would be no adjustment in the trading or P&L. Let us why we are not going to have adjustment. Purchases will be having debit balance, to balance brought down, and drawings is by drawings here, and the brought down balance will be written here. That means it is also already been deducted from the purchases, so there is no impact in the trading and P&L account, but it is simply deducted from the balance sheet, deducted from, not balance sheet, from capital in balance sheet. Okay, it is simply to be deducted from the capital in balance sheet. Let us know next adjustment. So there is no adjustment in balance sheet in trading or P&L account, but it is simply to be deducted from the capital in balance sheet by what this is goods withdrawn for personal use. And the next is similar to this one. Which is what 10th adjustment. Okay, this is what goods distributed as free samples. Goods are distributed as free samples. What does it mean by distribution of free samples? That means if the proprietor wants to increase his sales and wants to earn some more profits, then this is a technique which is incorporated by the proprietor to increase the profits. How? He is going to distribute some sample pieces of goods to the public, like an advertisement we can say. Okay, it is distributed to the public. If the public accepts that nicely, then one minute. So 1 minute friends, let us discuss again, continue with the concept. Okay, let us see. So it is a marketing technique which is applied by the proprietor to increase his profits and also to increase his sales. So it is a marketing technique which is used by proprietor to increase his profits as well as sales. So as it is also a distribution and it is also to be given outside, then we say that it is also an expenditure which is to be deducted from the purchases, and it is like an advertisement actually. So the adjustment entry would be advertisement account data to purchases, and this is the entry in which there will not be adjustment in the balance sheet, because advertisement is also an expenditure and it is also to be deducted from the purchases. So first situation when it is given in adjustments. So when it is given in adjustments, that is the first thing, and when it is given in trial balance, second situation when it is given in trial balance. Okay, let us see. When it is given adjustments, there are two things which we have to do in the trading and P&L account, and nothing is to be done in balance sheet because both are the type of expenditure. That is not at all drawings. If it is drawings, we have seen the before adjustment, that is ninth adjustment, goods withdrawn for personal use. Okay, but this is the adjustment regarding advertisement marketing technique. Okay, that is what the thing is. Let us see. Actually it is to be deducted from the purchases, that we already know. It is to be deducted from purchases in trading account. Okay, it is to be deducted from purchases in trading account, and as it is an advertisement and kind of advertisement, if it is available in profit and loss account, and if it is available in the trial balance already, that means advertisement is available in the trial balance, add it to advertisement, or to be shown as advertisement. Advertisement expenditure. Okay, advertisement expenditure and to be debited to profit and loss account. Okay, it is to be added to advertisement when it is when advertisement is given in the trial balance. Okay, and or if it is not given in trial balance, then we have to show this as an advertisement. Okay, then that will be not there is no adjustment in the balance sheet. And when it is given in trial balance, let us see. If we incorporate this entry, then what happens? Let us see the advertisement account to purchases. See, let me explain you. 1 minute friends. If advertisement account is already available in a trial balance, then it would be having balance in debit side to balance problem. As it is an expenditure, then that would be balance of debit balance. When it is when the goods are distributed as free samples, we are going to incorporate the entry to purchases here. Okay, then the total balance would be going to the credit. That means that would be carried on with the total amount, and later it is already brought down. Okay, that means it is the total amount is to be debited to P&L account. Let us see the purchases account. If the balance would be already available in the debit balance, to balance brought down, and when we incur purchase by advertisement, and the balance which is still available, that would be written here, and the total balance would be written down here. So that would already been adjusted with the purchases, and the total amount, if this balance exists, the total amount would be shown here. If that is already, if that does not exist also, we need to open one advertisement account. Okay, where it is given in trial balance, then what we have to do is what we was already written. Okay, then simply it is to be debited to P&L. That's it, and there will not be adjustment in the trading account. That's it, and of course this is not adjustment of the trading account, the balance sheet. Remaining. Okay, so this is the adjustment of goods distributed as free samples. Okay, this is the 10th adjustment which we have done. So let us go for the 11th adjustment now. This is the 11th adjustment. 11th adjustment, the name of adjustment would be closing stock. Very important adjustment. This is very important adjustment, which is what closing stock. And why the closing stock would be written on the credit side of trading account? Simply, that is the main thing, which is according to matching concept. What does matching concept says? Whenever any expense incurred, whenever any revenue generated, to generate the revenue, how much cost incurred, that should be matched. So that is what simply the definition for matching concept. I repeat, whenever any particular revenue generated, to generate that revenue, how much cost incurred, that should be matched and cancelled. Why it is like that? See, let us take an example. We have purchased total of 1000 samples, 1000 goods we purchased, and in which 1000 goods are sent to sale, and only 700 goods are sold. Okay, and the remaining 300 goods would be like a closing stock for us. For example, if we take a simple pro forma for trading account, we are going to write that simply if the total goods value is 100 per rupee. Okay, 100, then that would be recorded in the trading account to purchases in bracket 1000 into 100, which would be 1 lakh. Okay, the total purchases have been recorded with 1 lakh rupees, and we are saying that the 700 goods are sold, and let us assume the same value that are sold at cost only. So by sales we are going to record, right, how much value is 700 into 100, which would be 70,000 rupees, which would be 70,000 rupees. The sales value would be 70,000. So that means if we say the debit balance would be 1 lakh and the credit balance is only 70,000, then the difference would be what? 30,000. This 30,000 is the value of 300 goods. Okay, 300 goods, that is the expenditure. So for this 300 goods we have already incurred rupees 100 per unit per good. Okay, 100 per unit we have already incurred the expenditure. So but 300 revenue is not at all generated, but to generate that revenue already the cost incurred for 30,000 rupees. That is why we are matching with closing stock. The closing stock would be 30,000. That is what 300 units either 100 per unit, that would be 30,000. Okay, this is what a closing stock is. So what would be the entry for this closing stock and how to uh, value that closing stock, we are going to look at now.
హలో అన్న, అదే అన్న నీ దగ్గర కూర్చోబోతున్నా నేను. అదే 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 అక్కడ సిటీసీకి నీ దగ్గర అన్ని షాప్స్ తెలుసుంటాయి కదా. అదే అదే అన్న, ఇప్పుడు కంప్యూటర్ బజార్ అనే షాప్ ఉంది కదా, అదే అందులో పీసీ బిల్ చేసుకుందాం అనుకుంటున్నాము.
Okay, this is what
తెలుసు కదా, అనుకుంటామా అదే గమనించాను అన్నమాట అని నడుదామని. తీసుకున్నాను, మంచిగా తీసుకున్నాను. అదే అన్న పేరు ఆనంద్ అంట, ఉన్నాడు కదా.
okay, let us look at the adjustment regarding this one now.
మహేశ్వరి అని ఉంది.
The entry for the closing stock would be
నేను బుక్ చేసుకోవచ్చు అక్కడి నుంచి. అదే నేను నెంబర్ పంపించమని అడిగాను. మంచిదే కదా, తీసేసుకోవచ్చు కదా అంటున్నా.
closing stock account data to trading account.
అదే 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 ఓకే అన్న.
Closing stock account data to trading account would be the adjustment entry for closing stock. Okay, and there are two situations again when it is going in adjustments and what we need to do, and when it is given in trial balance what we need to do. So here this is somewhat different. Okay, actually when it is given in trial balance, 1 minute, let us write clearly. When it is given in trial balance what we need to do, when it is given in adjustments what we need to do. Okay, when it is given in adjustments, simply as we are credited to we are credited to trading account, so it is to be credited to
ఇంకొక హెల్ప్, ఆనంద్ అనే నెంబర్ ఏమైనా ఉందా అన్న? అవునవును,
it is to be credited to trading account. In bracket I am writing due to
నెంబర్ పెట్టావా అంటున్నా. అంటే ఆనంద్ మహేశ్వరి ఉంది కానీ లేదు అందుకని.
due to matching concept,
ఓకే ఓకే
and it is also to be shown as it is a stock, that means goods.
అదే అదే అన్న, సరే అన్న. అది ఆనంద్ మహేశ్వరి అని ఉంది. అదే అన్న.
to be shown as current liability in balance sheet. Not liability, I'm sorry, I'm very sorry.
అతను అకౌంట్ పెట్టాడు అంటే నేను కొన్ని పంపించలేదు బుక్ చేస్తాను అంటే అతను వీడియో పెడతా అన్నాడు
To be shown as current asset in balance sheet.
అదే అదే కంప్యూటర్ బజార్ అన్ని ఇచ్చారు.
It is to be shown as current asset in balance sheet. Okay, because it is a stock is what the remaining item with the go down, that is to be shown as current asset in balance sheet. Okay, that is what the trial by in adjustments, when it is given in adjustments. Then when it is given in trial balance, usually we are going to write that is the above entry was already written, but here we are going to incorporate two entries. The following entries were already incorporated, that means were already written. Okay, the following entries were already written. What are those entries? There will be two entries. The first entry would be purchases account that are to opening stock, purchases account that are to opening stock account, and the second entry would be closing stock account that are to purchases. Simply what we can say here is either if we credit to trading account or if we deduct from the purchases, that entry would be same. Okay, why? We have already seen in a trading account simply format, right? If we are having here two purchases 1 lakh. Okay, two purchases 1 lakh if we are having, and we have separated with closing stock.
ఇంకోటి తెలుసా నమ్మకం ఏంటో
If we deduct that closing stock and the remaining balance would be 70,000, that is actually matched with sales, by sales, which we have recorded here 70,000 actually. So we can, if we deduct from the closing stock from the purchases, the entry would be, the impact would be same, but as it is a closing stock, we are going to say it as stock, which is according to matching concept. Okay, but let us see here what we need to do. Okay, closing stock account added to purchases and purchases account added to opening stock. Then purchases would be appearing as appeared as adjusted purchases. Then the purchases would be appeared as adjusted purchases. If you see the word adjusted purchases in trial balance, then you need to think that the purchases is added with opening stock. The opening stock has already been adjusted to the purchases, and this closing stock will be shown in the trial balance. Okay, that is already been adjusted to purchases. Okay, the purchases would be appeared as adjusted purchases when it is given in trial balance. So what we need to do here? So let us see here. When it is given in trial balance, let us see here. Let us open purchases account. Let us open here the purchases account and opening stock account, and let us also open the closing stock account. Simply the opening stock is the closing stock for the last year. Okay, last year that would be opening stock, that would be closing stock, that would be appearing as an opening stock for the next year. Okay, let us see. Um, Purchases would be already having balance, two balance brought down. Okay, two purchases, sorry, purchases with two balance brought down. When we are incorporating the first entry, that would be two opening stock, and when we incorporate the second entry, that would be by closing stock, and the remaining balance would be by balance carried on. So the total balance would be written and balancing brought down would be written here. That means this closing stock is adjusted, the opening stock is adjusted, then there is no impact in the trading or P&L account. Simply, and let us see here by, so here two balance brought down with, let us take if the balance would be 60,000 and the opening stock is adjusted with the purchases will also be the 60,000. So by purchases that would also be with the same balance, then there will be no balance for opening stock. So let us now see. Okay, when the balance of closing stock would be appearing as what? Two purchases, and carried on balance would be there, brought down balance will also be there. As it is having credit balance, then we need to show this as current asset in balance sheet. So this will be acting as a side account. CA. I'm kidding. Okay. It will be appearing as a current asset in balance sheet. Then it is given in adjustments. When it is given in trial balance, this would be appearing as a current asset in balance sheet. This is the adjustment regarding closing stock. I'll explain you once again. Wait for a while. Okay, let us see. It would be appearing as a current asset in balance sheet. I'll explain you the closing stock entry once again. Simply, according to matching concept, that is to be credited to trading account. Why? What does matching concept says? Whenever any particular revenue generated, to generate that revenue, how much cost incurred, that is to be matched and cancelled. Okay. Here the closing stock value is 30,000. This is to be matched with the purchases by crediting to trading account. That is what the, if you understand this closing stock entry, then the remaining the things like abnormal loss would also be easier. Okay, that thing also we can understand in an easier manner. Okay, then as it is to be credited to trading account, we can credit to trading account by putting in the name of closing stock. The entry for that would be closing stock account added to trading account. Okay, and in trading account that would be appearing as a closing stock. Closing stock is like a asset, current asset in balance sheet, and it is to be credited to trading account. That would be the impact in when it is going in adjustment, that would be the impact, and it is to be shown as current asset in balance sheet. When it is given in trial balance, the two entries, purchases account added to opening stock account and closing stock account added to purchases account, would also be incorporated when it is given in trial balance. So there is no adjustment regarding in trading and P&L account, but is simply to be shown as current asset in balance sheet. Okay, let us go for now the next adjustments. Very important adjustments. These adjustments are very important. Let us now see. Let us see next adjustments. Okay, Next adjustment is how much? The number is 12th, right? Twelfth adjustment, which is capital expenditure treated as revenue expenditure. Capital expenditure is treated as revenue expenditure. We have discussed about this one in rectification of errors, right? You remember, right? Yeah. Capital expenditure treated as revenue expenditure. What is this? Let us take a small example for this one. Furniture purchased no, let us now say no, we shall take another example. Yeah, we shall take the same example which we are going to say. Furniture purchased and debited to purchases account. And debited to purchases account. Furniture actually it is an asset. This is a capital expenditure, but as it is debited to purchases, that is taken as revenue expenditure. Capital expenditure is now treated as revenue expenditure, which is a principle of omission. Principle of no, I'm sorry. Error of principle it is. It is an principal error. The capital expenditure is treated as revenue expenditure. Principle error it is. Then what adjustment is to be done here? So simply in original words what we can say here is, if that is to be shown as a capital expenditure, it is to be debited. That is capital expenditure. It is to be debited and revenue expenditure is to be credited in order to reduce that one to the revenue expenditure. Okay, is treated as revenue expenditure. If the capital expenditure is treated as revenue expenditure, then we need to show this adjustment, capital expenditure account to revenue expenditure account. Then what would be the entry for the furniture purchased and debited to purchases account? Here we can say here it has rectification entry. So we write here the entry furniture account data to purchases account. Furniture account data to purchases account. As it is a capital expenditure, we have debited the furniture. As it is as it is a decrease in the revenue expenditure, it is to be credited to purchases account. So this would be the rectification entry. Capital expenditure to as revenue expenditure. Then when it is actually this will be available maximum 99.99%, that would be taken into the adjustment only. If that is given in trial balance also, how we can decide whether it is an capital expenditure treated as revenue expenditure. So it will be maximum, it is given in adjustments only. Then what we can say here is, it is given in trial balance. When it is given in adjustments, then we can deduct from purchases in trading account. Which is to be deducted from purchases in trading account, and which is to be shown as current. This is furniture, right? Furniture is like a fixed asset. When it comes to furniture, that is a fixed asset. but usually when any asset is given, it is should be shown as asset in balance sheet, either fixed asset or current asset in balance sheet. Okay, this is maximum given adjustments. As if it is given in trial balance, then what we will be doing? In trial balance, the above entry was already incorporated. The above entry was already written. The above entry was already written. Then there would be no adjustments in regarding to trading and P&L account. So let us discuss one more adjustment, which is revenue treated as capital. What is that? Revenue expenditure treated as capital expenditure, 13th entry. Revenue expenditure treated as capital expenditure. When it is done like this, then what we would be doing? We would be reducing the capital expenditure and we would be increasing the revenue expenditure. Normal entry would be revenue expenditure account data to capital expenditure. Revenue account data to capital expenditure. This would be the normal entry, but for which we are going to take an example. This is an example actually. Let us take the example here. Okay, so let us take the example here. 1 minute, friends. Example for this would be what? Let us take here. Repairs to machinery debited to machinery account. Repairs to machinery debited to machinery account. What would be the rectification entry for this? What would be recording? The entry would be what? Repairs account debtor to machinery account. Which is revenue expenditure account data to capital expenditure account. Okay, this would be doing, and of course it is also to be shown in adjustment. When it is going in adjustments, what we would be doing? Simply to be debited to P&L, to be debited to profit and loss account, because this is an indirect expenditure. Profit and loss account to be debited. It is to be debited to profit and loss account, and it is to be credited to machinery. Credited or deducted from machinery in balance sheet. Okay, it is to be credited or deducted from machinery in balance sheet. It is what it is mean by credited. It is mean credited, that would be actually shown as a deduction from the balance sheet simply. But if it is given in trial balance, this entry would all be recorded. When it is going in trial balance, above entry was already written, right? So there will be no adjustment in trading and P&L and also in balance sheet. So that's it, folks. Thank you for watching. If you like my videos, please subscribe my channel. Thank you, and also share. Thank you very much. Bye.